Good morning, David Moore of Equity Advantage, and once again we've got Robert Smith of Peregrine Private Capital, and we're at April of 2022 to keep things in context. And we're going to start off talking a little bit about inflation today. So I had an interesting conversation last week, Bob, with a good friend. I'm blessed to have people in my life that I get to learn from, and you know my feeling about learning and being taught. I'm very happy to learn, tired of being taught. So many kicks to the head, it gets tiresome. But I was talking to my buddy Bob, another Bob, last week. And we were talking about inflation, and we were talking a little bit about what to do with money, because he happens to have a parcel of property that actually Washington County's trying to buy from him, and they're just saying, hey, we need this developed, and we want this from you. And he's like, well, okay, so where am I going? I'm not going to give up something until I know exactly what I'm going to buy. And he's been looking all over trying to find properties. He likes to own stuff. And so he just hasn't found a place to go. But we were talking about just inflation, what we're seeing. And one of the comments he made was something that I was, because I want to learn, right? So we have, with our IRA business, we have people buying into crypto with their IRAs and 401k plans. And yes, you can do that. And some of the people do very, very well with it, and others not so much. But, I asked him sort of his opinion on it. But the one comment, I won't go into that today, the one comment he made was, hey, at least there's a finite amount to it. You look at crypto, it's a finite deal with that blockchain situation. And he said, is there a finite amount of US dollars today? And I'm going to sort of ask you the question and let you answer that. But is there a finite amount of those dollars? And since there may or may not be, how does that impact the value and what we might see with inflation?
Well, short answer, clearly there is no limit to the number of dollars that the government is willing to put in circulation. Even now, with inflation here, that increased liquefaction of the economy proceeds apace. As a matter of fact, that's what I would really like to address today, and at the risk of being redundant, because 2 years ago we warned investors that inflation was coming, perfect storm of supply chain disruption and the government spending more money than God has. Mm-hmm. And unfortunately, that hasn't abated, despite the appearance of doing something about inflation by raising interest rates 1/4 point for the first time in a decade. The Fed really is doing absolutely nothing to address the inflationary issue. Quite the contrary, they're continuing. The only back up a little bit, the only way the Fed can at this point seriously address the inflation issue is to shrink their bond portfolio, meaning to start selling bonds and in so doing bring money back in out of the economy. Quite the contrary, the Fed is continuing to expand. They're continuing to buy more bonds, so they're continuing to inject liquidity into the economy. And as such, the amount of dollars in circulation continues to grow. The liquidity issue isn't abating, and so asset prices are going to continue to track higher. So what we see, we call it smoke and mirrors on the part of the government, is that this is not going to be addressed seriously near term. So inflation is going significantly higher. It's going to last longer, and it's going to have that should be the most important consideration going forward when you're making decisions with regard to your investments.
Interesting. So my other buddy Bob was talking about the worst thing you can do is keep your money in money today, right? And one of the things that I talked to him about a little bit, and you and I love cars, we love toys, like watches. But if you think about a watch today, you think about hard assets. Everybody hears the ads about gold, silver, palladium, whatever it might be, and they're all selling tangible assets. And then I think back on our business, in 1031s, we were able to handle exchanges of cars until 2017, Trump's tax reform. And dang it, Trump, you took cars away from us. But we used to play with the cars and boats and planes, all that stuff, businesses we could do exchanges for. And now we can't any longer. But that whole investment car industry has been going crazy. Mm-hmm. And I think it's because people are looking for, once again, hard assets, a place to put their money that's going to increase in value, whether it's art, cars, gold, whatever it might be. Even watches today. You go try to buy a nice watch, and there's a 2-year wait on this stuff. But we've said it before, I mean, real estate's the ultimate tangible asset. So if we sort of kick things back to, what your ballywick is, I mean, what you specialize in, and is sort of institutional real estate, it's the ability to buy into what I believe the ultimate tangible asset without being stuck with the terrible T's, right? And so if we look at your space and what you see, and if we talk about a normal, if you go and approach your financial advisor about, hey, I want to diversify into real estate, they're typically going to sell you what? A REIT, right? Which is, once again, a stock. So as far as what you just said with inflation, with what we're seeing, what do you see happening in the institutional real estate space?
Oh, what's happening, I mean, last year was a record year in terms of the inflow of institutional money coming into commercial real estate or income-producing properties. And that huge acceleration of money was catalyzed in large part by inflation, because historically one of the best inflation hedges has been leveraged real estate, because one, it's a hard asset, so it tends to gain in value rather than lose in value. And being leveraged, you get to play the same game that your government is going to play in terms of inflating away debt. So you can oftentimes build equity faster in a property in an inflationary environment when it's levered, because much of that debt is going to be paid down or inflated away with dollars that are worth less. So the bad news for investors generally is that inflation's here, it's here for a while, and it's going to get worse. The good news specifically for income-producing property investors is historically leveraged commercial real estate has done very well in an environment like this. It simply is a question of what type of real estate performs best. And we've been emphasizing to our investors for quite some time now the desirability of operating assets. Operating assets are those commercial properties with numerous tenants and relatively short lease intervals, whether it's self-storage, multifamily, senior living, manufactured housing, because what that short lease interval does, assuming you can keep it fully occupied, is it gives you the flexibility to increase your rents with as much frequency as possible to keep you and your money ahead of the curve of the steadily devaluing dollar. And that's what we saw very, very specifically last year with a flood of institutional money coming into real estate. They were very, very, very specific from a targeting standpoint. They hit self-storage very hard and multifamily assets very hard, because they now see self-storage with its month-to-month lease intervals as the ultimate inflation hedge in the operating asset space.
Wow.
And, obviously tremendous pent-up demand for housing coming out of the pandemic. So they hit that very, very hard as well. And we're not seeing much of a slowdown of institutional money into the commercial real estate space now. What we think is going to happen is that river of money may start to broaden out as they start to look for better values and asset types that weren't included in the initial deluge, if you will, last year. Things like senior living, student housing, asset types that were hit harder during the pandemic may indeed represent excellent opportunities because they have better valuation multiples in terms of acquisition cap rates, higher attendant cash on cash return. And so if that influx of money doesn't abate, which we don't think it's going to, it should positively impact those asset types as well this year as it did with self-storage and multifamily last year. So we don't see it slowing down much at all. We really don't.
Interesting. So I was sitting there listening. I love having smart friends. So it's like I get to sort of absorb this stuff a little bit, right? And that's one of the things I really enjoy about doing these things is talking to people and learning. So I was just thinking as you were talking about historically, what do people do? They start with a rental house and they go to another, or a home that they convert to a rental, and they end up mushrooming, snowballing that into whatever it's going to do. More and more rental houses till they get tired of doors or tired of spaces, and we always used to say, well, 4 rental houses is 4 roofs, 16 walls, 4 yards, and they're scattered around. So you go get a 4-plex, it's 1 roof, 4 walls, 1 yard, and it's that economy of scale. And then at some point you get tired of dealing with the doors, and so somebody says, well, hey, go buy a big box single tenant building. But those things have leases with their preset escalators, right? Yes. And with this, they don't anticipate the type of inflationary periods we have right now. So you could be in a situation where, and number one, the big box is great and what works wonderfully until it doesn't, right? So if we just look at Walgreens, for example, in the Bay Area, what they've closed 28 stores. How would you like to be one of those owners? I mean, so you start thinking about that, you really lose control of that situation. And one of the big aversions to, let's say, the institutional, the DST space is people feel like, well, gee, I don't have control. They might not like that, but it's something that you've got that diversification of assets and locations, whatever it might be, where, yeah, you might own that big box single tenant building. You got control of it, or do you? And I think times like we're going through, it really can change somebody's investment dramatically, just with all this unanticipated extreme inflation.
I think that's the best possible point to make, is that fundamental difference between commercial property types. Operating assets, as we mentioned earlier, those property types with multiple tenants and short lease intervals, and single tenant net or triple net retail properties with a single tenant, big box, long-term lease. And obviously, in a declining interest rate environment, single tenant, triple net leases are great, because as interest rates continue to go down, prices continue to go up, and whoever is going to buy that next from you is going to pay you more rather than less. When that process reverses itself and interest rates start going up, being driven by inflation, then I think you have to question the efficacy of those single tenant, triple net lease assets, because as you just mentioned, you don't have the flexibility to raise rents. I mean, there's a trade-off. People obviously, from an emotional standpoint, they derive a sense of security. Wow, I've got a big corporate tenant, it's a long-term lease, 10, 15, maybe 20 years if you can still find it, and that gives them a sense of security. And again, in a declining interest rate environment, that's great. Maybe it's not so great in an increasing interest rate and inflationary environment, because, as you just mentioned, rent increases are preset, and there's no guarantee that those rent increases will keep pace with inflation or the rate at which the Fed ultimately will have to raise interest rates to combat that, whether or not they want to, okay? Whereas with operating assets, you have greater flexibility to try to stay ahead of the curve. And I think that's a distinction that most people coming into the commercial real estate space don't get. And it's clearly something that most brokers aren't going to make a distinction between, because they simply want to place that person in some type of asset. So couldn't agree with you more that the inflationary environment that we're in now, that, remember, this is the first time in 40 years, this is a generational mistake on the part of Jerome Powell and the Fed, having resurrected the inflationary dragon for the first time in 40 years. So this is something that most financial service professionals and young real estate professionals have never experienced, have never lived through. I'm certainly old enough to have lived through the inflation of the late 70s and 80s, so it's part of my mindset. And that's why we were the first person in the first entity in the DST space 2 years ago to warn people of the inevitability of inflation. And so it's, that's the most important consideration we think you as an investor have to make in terms of when you're deciding on what asset type to reinvest in. You have to ask yourself, how is this going to be impacted by the current inflationary spiral that we're in now? Is this a good thing for the asset, or is it a bad thing for the asset?
Thank you.
Yeah.
Very good explanation. David Moore, Equity Advantage with Robert Smith at Peregrine Private Capital, and we'll be right back. Thank you.
Straight back to you. Took out my phone and I feel nervous and confused about